Module 1, Introduction to the P/E ratio. The price-to-earnings (P/E) ratio is a financial metric used in stock valuation to assess the relative value of a company's stock. It is calculated by dividing the market price per share of a company's stock by its earnings per share (EPS). The formula is as follows: P/E ratio equals market price per share / earnings per share (EPS). The P/E ratio provides insights into how much investors are willing to pay for each dollar of the company's earnings. It is often considered a reflection of market sentiment and expectations about the company's future growth prospects. Here are a few key points about the P/E ratio and its significance. Relative valuation. The P/E ratio is primarily used to compare the valuation of different companies within the same industry or sector. By comparing P/E ratios, investors can evaluate whether a stock is overvalued, undervalued, or fairly priced compared to its peers. Earnings multiple. The P/E ratio represents the earnings multiple that investors are willing to pay for a stock. For example, a P/E ratio of 20 indicates that investors are willing to pay 20 times the earnings per share to own the stock. Higher P/E ratios generally suggest higher growth expectations or market optimism, while lower P/E ratios may indicate lower growth expectations or market pessimism. Growth expectations. The P/E ratio is influenced by investors' expectations of a company's future earnings growth. If a company is expected to have high growth potential, investors may be willing to pay a higher multiple of its earnings, resulting in a higher P/E ratio. Conversely, companies with lower growth prospects may have lower P/E ratios. Risk and volatility. The P/E ratio can also reflect the perceived risk and volatility associated with a stock. Companies with uncertain prospects or higher risk may have lower P/E ratios as investors demand a higher return on investment to compensate for the risk. Conversely, stable and established companies with lower risk may have higher P/E ratios. Limitations. While the P/E ratio is widely used, it has certain limitations. It does not capture the complete picture of a company's valuation, and other factors such as industry dynamics, management quality, competitive advantage, and macroeconomic conditions should also be considered. Additionally, P/E ratios can vary significantly across industries, making direct comparisons between different sectors less meaningful. It's important to note that the interpretation of P/E ratios varies depending on the industry, company size, growth stage, and market conditions. Investors should consider multiple factors and use the P/E ratio as one tool among many when making investment decisions. The P/E ratio, or price-to-earnings ratio, is calculated by dividing the market price per share of a company's stock by its earnings per share (EPS). The formula is as follows: P/E ratio equals market price per share / earnings per share (EPS). To calculate the P/E ratio, you need two key pieces of information: market price per share. This is the current market price at which the company's stock is trading. It can be obtained from stock exchanges or financial websites. Earnings per share (EPS). This is the company's net earnings, profits, divided by the number of outstanding shares. EPS is typically reported in the company's financial statements, such as the income statement or the earnings report. Once you have the market price per share and the earnings per share, you can divide them to calculate the P/E ratio. The interpretation of the P/E ratio in relation to a company's earnings depends on various factors. High P/E ratio. A high P/E ratio indicates that investors are willing to pay a higher price for each dollar of the company's earnings. It could imply that the market expects strong future earnings growth or has high optimism about the company's prospects. However, a very high P/E ratio could also suggest that the stock is overvalued or that investors have excessive expectations, which may pose a risk if the company fails to meet those expectations. Low P/E ratio. A low P/E ratio suggests that investors are paying a lower price for each dollar of the company's earnings. This could indicate undervaluation or market pessimism about the company's future prospects. It may present an opportunity for investors if they believe the market has underestimated the company's potential. However, a low P/E ratio could also reflect concerns about the company's financial health, growth prospects, or other risks. Comparison with industry or sector. The P/E ratio is most valuable when comparing companies within the same industry or sector. A company's P/E ratio should be evaluated relative to its peers to determine if it is higher or lower than the industry average. Comparisons help assess whether a company is relatively expensive or inexpensive in relation to its competitors. Growth rate. The P/E ratio should be considered in conjunction with the company's earnings growth rate. If a company has a high P/E ratio, but it also has a high growth rate, it may be justifiable as investors are paying for the expected future earnings. Conversely, a low P/E ratio with a low or negative growth rate may indicate potential concerns about the company's performance. Other factors. While the P/E ratio is a useful metric, it should not be the sole determinant of investment decisions. Factors such as industry dynamics, competitive landscape, management quality, balance sheet strength, and market conditions should also be considered. Remember that the interpretation of the P/E ratio can vary depending on the industry, company size, growth stage, and market conditions. It is important to conduct thorough research and consider multiple factors before making investment decisions based on the P/E ratio. The P/E ratio is a widely used valuation metric, but it has both uses and limitations. Let's explore them. Uses of the P/E ratio. Relative valuation. The P/E ratio is commonly used for relative valuation. By comparing the P/E ratios of different companies within the same industry or sector, investors can assess the relative attractiveness of stocks. A lower P/E ratio compared to peers may indicate a potential undervalued opportunity, while a higher P/E ratio may suggest overvaluation. Assessing market sentiment. The P/E ratio provides insights into market sentiment and investors' expectations. A high P/E ratio may indicate optimism and expectations of strong future earnings growth, while a low P/E ratio may reflect pessimism or concerns about a company's prospects. It can be a useful tool to gauge market sentiment and sentiment shifts. Historical analysis. The P/E ratio can be used for historical analysis of a company's valuation. By comparing the current P/E ratio to its historical average or the industry average, investors can identify trends or deviations from the norm. It helps in evaluating whether a stock is trading at a premium or a discount compared to its historical levels. Sector comparison. The P/E ratio is effective for comparing companies within the same sector. It allows investors to evaluate the relative valuations and growth expectations of companies operating in similar business environments. This helps in identifying outliers and potential investment opportunities. Limitations of the P/E ratio. Industry variations. Different industries have different P/E ratio ranges due to variations in growth rates, risk profiles, and capital intensity. Comparing P/E ratios across sectors may not provide meaningful insights. It's important to consider industry-specific benchmarks and factors while interpreting the P/E ratio. Earnings quality. The P/E ratio is based on earnings per share (EPS), which can be influenced by accounting practices and non-recurring items. Companies can manipulate earnings to present a more favorable P/E ratio. It is crucial to scrutinize the quality and sustainability of earnings before relying solely on the P/E ratio. Lack of context. The P/E ratio does not provide a complete picture of a company's valuation. It does not consider other important factors such as debt levels, cash flows, growth prospects, competitive advantages, and management quality. Relying solely on the P/E ratio may result in overlooking critical aspects of a company's valuation. Cyclical and non-cyclical companies. Cyclical companies with earnings that fluctuate with the economic cycle may have higher P/E ratios during periods of high earnings and lower P/E ratios during downturns. Comparing their P/E ratios with non-cyclical companies may lead to incorrect conclusions. Future growth. The P/E ratio reflects market expectations of future earnings growth. If a company's growth prospects are not accurately priced in, the P/E ratio may misrepresent its value. It is important to consider other growth indicators and perform a thorough analysis beyond the P/E ratio. In conclusion, while the P/E ratio is a useful valuation metric, it should be used in conjunction with other factors and metrics to make informed investment decisions. It provides a snapshot of market sentiment and relative valuation, but it has limitations that need to be considered. Investors should conduct a comprehensive analysis, considering the company's financials, industry dynamics, and future prospects, to obtain a holistic view of a stock's value.